If you observe carefully the history of markets, you'll see that the most dramatic collapses never happen by chance. They follow a pattern as predictable as the tides. In March 1980, the price of silver collapsed from $50 to $10 per ounce in a matter of days. It wasn't luck. It wasn't bad luck. It was the economic machine working exactly as it should work. When you understand the incentives, you understand the behavior. And when you understand the behavior, you see that what appears to be coincidence is, in reality, a logical and inevitable consequence of decisions made long before the collapse happened. The story of silver in 1980 isn't just about two Texas brothers who tried to monopolize a market. It's about how leverage, greed, and misunderstanding of cycles can transform dreams of wealth into financial nightmares. It's about how markets function like a living organism that eventually corrects all imbalances. And it's a lesson that each of us needs to understand if we want to protect our wealth in a world where the same patterns repeat, just with different assets. History is an excellent teacher, especially when it comes to speculative bubbles. What happened with silver in 1980 wasn't the first nor the last example of how greed and leverage can create and destroy fortunes in a matter of weeks. To understand why silver collapsed at the exact moment of the margin call, we need to go back a few years and observe how this machine was assembled in the late 1970 seconds. The world was experiencing a period of high inflation. The dollar was weak. Gold and silver were seen as safe havens against currency devaluation. It was in this context that the Hunt brothers, Nelson Bunker Hunt and William Herbert Hunt, decided to make the play of their lives. They didn't just want to invest in silver, they wanted to control the global silver market. If you observe carefully, you'll see that this wasn't an impulsive decision. It was a calculated strategy based on a simple economic theory. If you control the supply of something everyone wants, you control the price. The Hunt brothers started buying physical silver, tons and tons of silver, but that wasn't enough for their grandiose plans. They needed leverage. They needed futures contracts. They needed more silver than their billions could buy outright. And that's where the collapse machine began to be assembled. Because when you use leverage to bet on any asset, you're not just buying a position. You're creating a time bomb that can explode the moment the market moves against you. History teaches us that every speculative bubble follows the same pattern. First, there's a legitimate reason for the asset to rise in price. Second, smart speculators enter early and make money. Third, greed attracts more people who use more leverage to maximize their gains. Fourth, the price rises so much that it loses any connection to economic reality. And fifth, something breaks. And when it breaks fast and violently. Silver in 1980 followed this script to perfection. To understand why silver collapsed at the exact moment of the margin call, you need to understand three fundamental principles that govern all markets. First, leverage amplifies both gains and losses. When the Hunt brothers started buying silver futures contracts, they weren't using just their own money. They were using leverage, basically. Borrowed money secured by the very silver they were buying. This means that for every dollar they invested, they controlled many more dollars worth of silver. If silver went up 10%, they didn't just gain 10% on their investment. Depending on the leverage, they could gain 50%, 100%, or more. But there's a universal rule in markets. What amplifies your gains also amplifies your losses. If silver fell 10%, they wouldn't lose just 10%. They could lose 50%, 100%, or even more than all the money they invested. Second, margin calls are the immune system of markets. A margin call is what happens when your losses become so large that you need to deposit more money to keep your positions open. It's like a fire alarm that goes off when things get dangerous. Markets created this mechanism for a very simple reason: to prevent speculators from breaking the entire system. When you use leverage to buy assets, you're essentially making a promise. You're promising that if things go wrong, you'll have enough money to cover your losses. The margin call is the moment when the market collects on that promise. Third, forced liquidation creates vicious cycles. When you receive a margin call and don't have money to deposit, you're forced to sell your positions. It doesn't matter if you believe the price will go up tomorrow. It doesn't matter if you think you're selling at the worst possible moment. You have to sell, and you have to sell now. And when many people are forced to sell at the same time, the price plummets. And when the price plummets, more people receive margin calls. And when more people receive margin calls, more people are forced to sell. It's a vicious circle that can destroy fortunes in a matter of days. These three principles explain exactly what happened with silver in 1980. The Hunt brothers used massive leverage to buy gigantic positions in silver. When the price started to fall, they received margin calls. And when they couldn't deposit enough money to maintain their positions, they were forced to sell. And when they sold, the price crashed even more, creating more margin calls for other speculators. It wasn't coincidence. It was the machine working exactly as it should work. Imagine you own a small electronics store. You believe the iPhone is going to be a success, so you decide to bet your entire financial reserve buying iPhones to resell. But you don't stop there. You take out a bank loan, using your own store as collateral, to buy even more iPhones. And then you discover you can buy iPhone futures contracts, promises to deliver iPhones in the future at a price fixed today. So you sign contracts to deliver 1,000 iPhones per month for the next 2 years. You don't have 1,000 iPhones. You don't even have money to buy 1,000 iPhones. But you're certain that the price will rise so much that you'll be able to buy the iPhones cheaper and deliver them at the higher prices you contracted. This is essentially the strategy the Hunt brothers used with silver. Now imagine that suddenly Apple announces it will produce iPhones in much larger quantities. The price of iPhones starts to fall. Your financial reserves evaporate. The bank calls demanding payment on the loan you used to buy iPhones, and you still need to deliver 1,000 iPhones per month for the next 2 years at the high prices you contracted. But now you need to buy those iPhones at prices that, while lower than before, are still higher than what you'll receive upon delivery. You need to sell your current iPhones to try to cover the losses. But when you sell, you push the price even lower. And the more the price falls, the more money you need to fulfill your contracts. This is exactly what happened to the Hunt brothers. They bought so much silver and signed so many futures contracts that they became a significant force in the global silver market. When they started buying aggressively, the price of silver rose from about $5 to more than $50 per ounce. They were making billions on paper, but they were so big in the market that their own presence was distorting prices. And when something eventually forced them to sell, and something always forces over-leveraged speculators to sell, they couldn't exit the market without destroying the price of the asset they were invested in. It was like trying to get out of a small pool while being an elephant. Every movement created giant waves. The irony is that if the Hunt brothers had bought the same amount of silver over many years without using leverage, without trying to monopolize the market, they probably would have made a lot of money and kept that money. But greed led them to want everything immediately. And the market taught them it doesn't work that way. You might be thinking, I'll never try to monopolize the silver market. This story doesn't apply to me. But if you observe carefully, you'll see that the same principles apply to almost all financial decisions you make. Every American planning their retirement is in some way making bets in the markets. You're betting that your stocks will rise in value. You're betting that your house will maintain or increase its value. You're betting that your bonds will pay the promised interest. And if you don't understand the risks of these bets, you might end up facing your own margin call moment. The Hunt brothers put essentially their entire fortune into a single asset, silver. When silver collapsed, they lost everything. Many Americans do the same thing, just with different assets. They put all their retirement money into technology stocks because technology always goes up. Or they put everything into real estate because real estate never falls. Or they leave everything in savings because at least I won't lose money. Each of these strategies is a way of concentrating all your risk in a single bet. The lesson from silver is clear. No matter how confident you are in investment, never put more money into it than you can afford to lose. The Hunt brothers used explicit leverage through futures contracts, but many Americans use leverage without realizing it. When you buy a house with financing, you're using leverage. When you keep money invested in stocks while having credit card debt, you're using leverage. When you withdraw money from your home equity to invest in other assets, you're using leverage. Leverage isn't necessarily bad, but you need to understand that it amplifies both gains and losses. And you need to be sure you can make the payments even if your investments go wrong. The Hunt brothers went bankrupt because when they received margin calls, they didn't have enough liquid money to cover the losses. All their wealth was invested in silver. Many Americans make the same mistake. They invest all available money because idle money is lost money, but idle money is also money that's available when you need it most. If you don't have at least 6 months of expenses in a savings account, you're essentially operating without a safety net. And when markets panic, and they always panic eventually, you might be forced to sell your investments at the worst possible moment. Silver rose from $5 to $50 in little more than a year. This created the illusion that prices could only go up. Many people bought silver at $40, $45, $50, thinking they would make easy money. We see the same psychology in all markets. When stocks rise for many consecutive years, people start to believe that this time is different. When real estate rises for a long time, people start to believe that real estate never falls. But history teaches us that all assets go through cycles. Periods of highs are followed by periods of lows. Periods of lows are followed by periods of highs. If you understand this, you won't panic when your investments fall, and you won't become overly confident when they're rising too much. Based on the principles that govern all markets, true diversification is fundamental. Most people think they're diversified because they have stocks from different companies, but if all those stocks fall at the same time, you're not really diversified. True diversification means having assets that behave differently in different situations. Some assets that rise when there's inflation, others that rise when there's deflation. Some assets that benefit from economic growth, others that benefit from recession. This can include stocks, bonds, commodities, real estate, and even some money in different currencies. The idea isn't to maximize your gains in any specific situation. The idea is to make sure you never lose everything in any specific situation. Maintaining sufficient liquidity is crucial. The Hunt brothers lost everything because they didn't have liquid money to cover their margin calls. You always need to keep a significant part of your wealth in assets you can convert to cash quickly without significant loss of value. This can be a savings account, certificates of deposit, short-term bonds, or money market funds. The exact amount depends on your situation, but a general rule is to keep at least 6 months of expenses in liquid assets, and if you have riskier or more volatile investments, consider keeping even more. Leverage should be used with extreme care. Leverage can help you make more money when things go well, but it can also destroy your wealth when things go badly. If you're going to use leverage, use it very carefully. Never use more leverage than you can cover with your liquid assets. And always assume that your leveraged investments can lose much more value than you expect. Studying cycles is essential. All assets go through cycles of highs and lows. If you understand these cycles, you can make smarter decisions about when to buy and when to sell. This doesn't mean trying to predict exactly when markets will rise or fall. It means understanding that when something has risen very rapidly, it's likely to go through a correction. And when something has fallen very rapidly, it's likely to recover eventually. History doesn't repeat exactly, but it rhymes. The Hunt brothers didn't have a plan for what to do if silver started to fall. They believed so strongly in their strategy that they didn't consider the possibility of it going wrong. You always need to think about what you'll do if your investments lose 20%, 50%, or even 80% of their value. This doesn't mean you should expect this to happen. It means you should be prepared in case it happens. Having a plan helps you make rational decisions in moments of panic, and it helps you avoid the most common mistakes people make when they're afraid. One of the reasons the Hunt brothers lost so much money is that they followed the crowd. When everyone was buying silver, they bought even more silver. When everyone was using leverage, they used even more leverage. The best investors do the opposite of the crowd. They buy when everyone is selling, they sell when everyone is buying. They become cautious when everyone is confident. They become optimistic when everyone is pessimistic. This isn't easy to do psychologically, but it's one of the most effective strategies for protecting and growing wealth long term. The story of silver in 1980 teaches us a fundamental truth about markets and about life. It wasn't coincidence that silver crashed at the exact moment of the margin call. It was the inevitable consequence of decisions made when prices were rising and everything seemed to be going well. The Hunt brothers didn't lose their fortune in March 1980. They lost their fortune the moment they decided to bet everything on a single strategy. They lost their fortune the moment they started using excessive leverage. They lost their fortune the moment they stopped considering the possibility of being wrong. The March collapse was just the moment when those earlier decisions materialized into concrete losses. If you observe carefully, you'll see that all major financial collapses follow the same pattern. They don't happen because markets suddenly went crazy. They happen because intelligent people made decisions that seemed rational at the time, but that contained the seeds of their own destruction. The economic machine is extremely efficient at correcting imbalances. And the greater the imbalance, the more violent the correction. The Hunt brothers created a gigantic imbalance in the silver market, and the market corrected that imbalance the only way it knew how, by destroying those who created it. The lesson here isn't to avoid markets. The lesson is to understand how markets work. The lesson is to respect the power of leverage. The lesson is to never bet more than you can afford to lose. The lesson is to always maintain a reserve for situations you can't predict. History is an excellent teacher, but only for those willing to learn from others' mistakes. Markets will continue going through cycles of highs and lows. They'll continue creating and destroying fortunes. They'll continue rewarding prudence and punishing excessive greed. The question isn't whether you'll face difficult times in the markets. The question is whether you'll be prepared when those times arrive. If you understand the principles that govern markets, if you diversify appropriately, if you maintain sufficient liquidity, and if you use leverage carefully, you'll have much better chances of protecting and growing your wealth long term. And you'll never have to experience your own margin call moment, because you'll understand that true wealth doesn't come from betting everything on a single card. True wealth comes from playing a game you can keep playing for a long time. And that, in the end, is the difference between speculating and investing. It's the difference between being rich for a moment and being rich for a lifetime.